Most ecom brands don't fail because of bad ads. They fail because they run out of cash, clarity, or control.
The most important thing of any CFO is cash, right? Because without cash, you're dead. The goal in business is just to stay alive. You learn, you grow, you develop.
Seamus O'Connor is a fractional CFO who oversees $1.4 billion in annual revenue across a portfolio of 7, 8, and 9-figure ecom brands.
I don't know anyone else in the world, to be honest, as big as us right now. We'll probably oversee about $1.4 billion this year.
And in today's episode, we unpack what the modern CFO actually does in high-growth ecom brands and why finance should enable growth and not restrict it.
Finance need to respect and understand that marketing is the heartbeat, marketing is the engine of the business, okay? And you need to give them the tools they need to grow.
The key metrics that separate brands that scale cleanly from brands that silently bleed cash.
The LTV on a subscription is much more valuable than an OTP. You're probably talking 2, 3, 4x over a 12-month time frame.
How top operators think about cash flow, forecasting, inventory, and capital allocation at each stage of growth.
Or are you just scraping by every month? Maybe you've got the wrong structure. Maybe you've got the wrong product. So really look at it and go, right, do I see this business going to 20, 30, 50, 100 million plus?
And when to raise capital, when to avoid it, and how to grow without gambling the business.
If you're borrowing money to cover losses, that's a really, really risky thing to do because that needs to be paid back.
So if you want to build an ecom brand that lasts, not just one that looks great on the Shopify dashboard, then this is the episode for you. Seamus, thank you so much for joining me on the pod.
Good to be here, Jordan, man.
Look, I know today we're going to talk a lot about CFO stuff, but I want to kick off with your background, because I know you started off in kind of the corporate space.
I did.
You've had an interesting journey. So do you want to just kind of walk in through that at a super high level?
Sure. How far do you want me to go back? To the very beginning?
School, yeah.
School, okay, wow, okay. Well, being in Dubai is a bit ironic because I grew up in a small rural part of Ireland. There's probably more people in this building right now than where I was, where I grew up, in a small village. It's about 600 people. Grew up on a farm, countryside, great upbringing, loved that. Yeah, I think that's where my work ethic comes from too. I was growing in the farming all the time.
So early mornings for sure, right?
Yeah, exactly, yeah. Weekends, everything was great. I went to primary school, had a great childhood, great upbringing, playing sports, messing around with my mates and everything. Went to secondary school, played a lot of sport. Always kind of had that entrepreneurial spirit, I think. I was burning CDs when I was 12, selling them in school. Importing sports equipment from Canada at 15, selling it. Just doing a bit of a wheeler dealer as a kid, which I think I've always had that. Then finished secondary school and then went to university. It was around the time of the economic crash in Ireland. So my dad convinced me to take a safe route, so I ended up doing law and accounting in university. Won't lie, didn't go to much lectures, but I could always get by. Got my degree. Then I ended up getting a training program in Deloitte in Dublin, one of the largest consultancy firms in the world. And in there I trained in international tax and finance. So great place to work. I've a lot of my friends today I've met there. Mm-hmm. But working with some of the best people in the country, in the world actually, when it came to international tax. Working with clients like Amazon, Toyota, Disney, multinationals was fantastic learning. Studied there to be a chartered accountant and a chartered tax advisor. Got those qualifications, really, really good to have. Stayed there for maybe 4 or 5 years, got qualified. Then went to work brand side, they call it industry.
Was that always the plan? So when you kind of started at Deloitte, was that the plan?
There was never really a plan, man. Deloitte training contract is like being in university, but just having to go to work at 9 to 5. It was good fun, going out with your mates, going for beers every Thursday night, working during the day. Because there was 30 in, let's say, our intake, it was called. Yeah. 30 of us starting together just out of college. There was never really any plan, to be honest, man. Just learning, taking it day by day. I think when you're there, you obviously think, someday, I wouldn't mind being a partner here, Mm-hmm. But yeah, I think as time went on, then I realised that's not really what I wanted to do, ultimately, be a partner or do that. And the advice I was given was if you don't want to be a partner, you're better off, getting out and doing something else. Mm-hmm. So a good opportunity came up to go and join a company called Kerry Group. They're, I don't know what they're doing now, maybe 8 or 10 billion a year. They're the largest food ingredient, or one of the largest food ingredient companies in the world, based in Ireland. Went to work there for a little bit, again, doing a lot of M&A group, worldwide taxation and stuff. So it gave me very, very good grounding on that. Then another good opportunity came up to leave them to go work for a Swiss company called Arista. Now they're listed on the Swiss stock exchange, but they were the HQ was in Dublin. Again, doing a lot of international tax, a bit of M&A, but I used to manage like their global, or not manage, but like was the financial controller for like their global financing structure. So flying to like Netherlands, Luxembourg, everything was really, really interesting. Did that for about, I think 2 years maybe, two and a half years. And COVID came towards the end of that. We ended up selling our US division, which was about 40% of the group. So I knew there was going to be redundancies on the table. So I just said to my boss, look, I'm kind of want to try something different. So I just ended up seeing out that project, took redundancy. And then from there, sorry, at the time I was there, we were was building a SaaS with a friend of mine. So we spent about 1.5 years building this SaaS. Spent about 2 years of our lives on that, a lot of money.
Yep.
And as part of that SaaS, we'd built a bit of a following online. Anyway, long story short, that SaaS ended up failing miserably. My buddy went back to work, and I just, since we had the following, I just started doing some like work with these people, just some like basic finance work. Again, it was during COVID, so at home. So we ended up just booking a one-way flight to Marbella, and moved to Marbella. Started meeting some. But actually started working with people in like agencies. Adam Power was one of the first guys I met and was working with. I know you know Adam as well. Yeah. Great guy. Then just was out in Marbella meeting people in the eCom space. Because my background had always been like international tax and finance, I really understood, cross-border stuff, foreign exchange, M&A. I knew all that. So I just started again working with some eCom guys, and it just went from there.
So kind of people are asking you for help rather than you deliberately kind of setting up this business.
Yeah, exactly.
That's how it evolved.
That's how it evolved. Yeah, I just moved to Marbella. No real plan. Like I didn't sit down one day and do a business plan or like say, we're gonna launch like an eCom group or something like that. There was no plan. We just kind of saw opportunity, like kind of like a river, just followed the path of least resistance. And at the start, like we worked with loads of different types of clients. Like we even had like barbers, cafes.
No way. Okay.
At the very, very start. And then we narrowed it down to 3 main cohorts. We had eCom, digital marketing agencies, and influencers. Then we narrowed it down to 2, digital marketing and eCom. Yeah. And then about 2.5 years ago, we just went 100% to eCom. So we actually killed our the side of the business that used to work with digital marketers like yourself. Why
did you focus on eCom?
I think number one, so me and my co-founder Stu on the finance side, we're eCom guys. Like that kind of is more of our skill set is more accustomed to eCom. There's more scale, but I think the main thing was we just realized we could add more value on the eCom side. Like that's where, and it's what we enjoy doing more. So one lesson I've definitely learned in life is oftentimes, by doing less actually allows you to do more and being more focused on something.
Okay. And I think you're involved in 4 businesses now?
4, yeah.
Can you just talk to super high level?
Yeah, okay. So where we started was it's like a fractional CFO business. I don't know anyone else in the world, to be honest, as big as us right now. We'll probably oversee about $1.4 billion this year. And that's without taking on any new business. That's just current portfolios, forecasts for this year, which have been locked in, signed off. That's the first business, and that's me and my co-founder, Stu. Most of our clients are either in the UK or in the Middle East, but running businesses into the US. And we have a lot of actually Dutch clients as well. Okay. So that's kind of where our 3 main client bases. We don't really have any US-based clients because of the time zone, but a lot of clients living in the Middle East or Europe, but running into the US. Then we've got a growth advisory business. My co-founder Stu and Ben as well, where we provide like growth advisory. So we don't run like paid ads, but we look at like the strategy, the forecasting, almost kind of like a fractional CMO. So that's doing really, really well. That was started about 12 months ago, and that's really growing really, really quickly. Then we have our investment fund, so we actually invest in brands as well, which is really interesting. It's called the Operators Fund, so that's going really well. So it's all our own money. We'll probably go raise externally in the next 12 to 24 months.
Nice.
And then we have eClarity Core, which is basically like an accountancy firm for smaller brands, anyone doing from $250K a year, probably up to $5 million.
Yep.
On the fractional CFO side, we work with brands doing anywhere from, I would say, $5 million on the lower end up to about $250 million a year.
Okay. And you got SaaS as well, right?
And we've got the SaaS, which just launched. It's still in beta now, but there's a good few people using it. So, yeah, we always had a frustration. There was nothing really out there. Like a lot of people are using like Triple Whale to measure profitability and stuff. So we just kind of got a bit frustrated. So we ended up just building our own software that just gives you that like real detailed analysis of like where you're being profitable. So we've got like contribution margin by country, SKU level data, forecasting, LTV, it's all your marketing metrics. So it's really powerful too. Has AI baked in and everything, just basically telling you what to do and where to allocate capital, to drive the highest ROI in your business. So for an example, like you might have a SKU where, on the outset it might look like a poor performing SKU. It might have a low gross margin, etc. But on an absolute LTV basis, like people come back and buy that SKU more frequently. So it's really showing you how to allocate capital to grow your business and drive value.
Okay. And what kind of size brands is that best suited for?
Any size brands, to be honest. Like you could be doing, 10K a month to 10 mil a month, 20 mil a month. Like it's size agnostic. It's just again fully automated. Like just hooks into all your platforms, even like Checkout Champ, for example, Meta. We've all the ad platforms set up, open banking, everything just plugs in. It's pulling in live data. And AI is just doing its work then.
Nice. Okay. So you've got a lot going on. How do you split your time amongst, I think that was 5, not 4, right? Different projects.
5, sorry. 5, last count. Very, very good question. So the one thing we always do is when we're launching a business or have a business, right? We always have someone that's leading it and giving it 100%. So we have like a MD/CEO of every business.
Okay.
So it doesn't mean that we have to run every business. We're just almost like advising and setting the strategy and the direction. So for example, like I spend 90% of my time in the CFO business because that's my day-to-day. We're running that. But then let's say on the SaaS, the fund, core, and the growth advisory company, that's just more like strategy kind of roles.
Okay.
We had the vision. We've got people executing every day.
And do you think this also works because it's kind of like an ecosystem and each business like feeds into each other? It's not like some random kind of different, like you don't run a paddle business, right?
Exactly, exactly. So it's just a full funnel approach. So all we're missing now is for like people that want to get off the ground, so info products. But it's basically that full funnel approach. So whatever stage you are at in your journey, we want to be able to service and help you.
Okay, and do you think that's the best way if people are looking at doing other projects? That's kind of the only way.
Definitely, yeah. So I think there's a fine line between focusing on one thing and like spreading yourself too thin. So for example, like if we were to go and do like something completely different that's not related to eCom, I would say that's a mistake. Yeah. But because everything is actually related to eCom and to what we're doing anyway, I wouldn't see it as a distraction. And that full funnel approach is the best because it just opens the pool of leads. So any leads that come our way, we can just triage them and put them in the right bucket of where they would be best serviced. It's also creating a funnel then for the other businesses. So for example, let's say a brand comes in that's, let's say, just starting out and they just joined the SaaS. Well, the SaaS will help them grow. Then they will become a client in the core business. Core will help them grow. Then they will become a client in the CFO business. We'll help them grow. And then at the same time, if they're doing well and they need capital, we have the access to our fund, which can help them along that journey. So it's really that ecosystem that we can help a brand really propel.
And the final kind of secret is separate org charts for the businesses, and you're kind of, if you are involved, it's like board level.
Correct.
Not
so
day-to-day.
Monthly meetings, there if need us, but not involved in the day-to-day.
Okay. How do you spin up, I guess actually 2 parts of this. How do you decide like when is the right time or like what is the right thing to do as a new venture? And 2, how do you kind of get the new venture off the ground?
Very, very good question. How do you know if it's the right thing to do? I think you need to look at something very strategically because anything you do new, there's always a cost to that, right? I think Alex Hormozy says it's like 20% or something, but there's always a cost to doing something new. So you need to look at it very strategically and go, okay, if we do this, we'll take a hit in the short run because then we might lose a bit of focus or capital. But is this part of the longer term vision? And you have to be super honest with yourself. That's the first thing. And then secondly, once we've identified that, you need to go and find somebody to come in as a business partner to run that like 100% and give it all of their attention. Because one thing I've learned over the years, if there's not at least one person in the business giving it 100% focus and attention every day, it's arrogant to think you can outcompete someone that is doing that, right?
Okay. Double tapping on that then. So in terms of finding that person,
Yeah.
any tips or kind of what's your thought process or for that?
I have a very simple philosophy when it comes to business, and it's like, like business is just people doing business with people.
Mm-hmm.
So if you do good work for good people, that's going to build your network so strong. Because if you do good work for good people, they will tell other good people.
Mm-hmm.
If you do good work for bad people, they will just be, like they will, I don't know how to explain it, but they won't promote you, right? They won't shout about you. They'll probably just criticize. So that's one, If you do bad work for good people, they'll tell nobody.
Yeah.
And if you do bad work for bad people, like they will just tell everyone you're crap, right?
Yeah.
So doing good work for good people builds up your network, okay? And you build your brand and your reputation. And then off the back of that, then you get access to like great people around the world, whether it's, people you want to hire, people you want to work with as clients, right? People or partners, people you want to bring into your business as founders. It's about building that network. And it's not like going to networking events, right? It's about actually building connections and, relationships with other good people in the space with similar philosophies, similar values. I think that's the key. Mm-hmm. And you can call on that then as and when you need it.
Okay. You talked as well about kind of, when looking at a new venture, does it fit to kind of the overall North Star?
Yeah.
What is your kind of overall North Star?
That's a very, very good question as well. We're very value-driven people, I think, and we just love giving value. Like the eCom space, I'm biased, right? But the eCom space to me is the best community in the world. Like I know competitors that help each other, for example. Yeah. Like it's crazy. And I would like the digital marketing space. I would consider it part of the eCom sector, right? So everyone is helping each other, right? So we just want to be able to provide as much value as possible to the whole ecosystem, the eCom space, and that's why we've built this full funnel approach as well. That's probably our North Star. Like we want to be so we had like a metric before. It's like we wanted to make 100 entrepreneurs financially free by 2030. Now we are well on the way to that, which is very, very good. I don't have the exact number, but we are over halfway there. That was kind of one North Star we did have a few years ago. It's definitely changed, but I just think we want to be like the largest like D2C advisory company, in the world.
Okay. Let's go into the finance side now. So what, in your eyes, should a kind of CFO for an ecom brand be doing in 2026?
So I think the main thing they need to do is they need to understand like what is the actual trading plan of the business that drives, growth and performance. Okay, so you need to sit down as a leadership team and understand what are our unit economics and what are our metrics that are going to make this a success. So are we trying to grow top line as quick as possible, and sell this? Are we trying to generate profit to put cash in the founders' pockets? Like what are we trying to do here? And then from there you reverse engineer it. So then you can say, okay, we want to grow as quickly as possible. Okay, we want to do that. How do we do that? We can either bootstrap it, okay, and get some debt in, whatever, or we can raise equity. But to do all these things, like it all comes back to unit economics. Like if you're a one-time purchase focused business, right, where you're reliant on CAC every month, you need to understand, well, what CAC can I pay to acquire a customer based on my margins to make enough money to keep growing?
Yep.
If you're a subscription-based business, it's a little bit, it's more complicated, but it's actually easier because like looking at data and information. If I spend X today, number one, what's my payback? And my payback in 30 days, 60 days, 90 days, 180 days. That's the cash flow gap you have to have. And then secondly, what's my LTV over, let's say, 3, 6, 9, 12-month basis too. And that's what drives enterprise value in the business. Like the lenders and the equity investors in the D2C space are very, very shrewd, very, very smart, all great people. And they see through this. They will look at all this stuff. And if your unit economics are strong, you could be loss-making because you're growing. They will still lend to you. They will still give you cash because they know in the long run this is a very viable business.
Okay. So you're kind of building that plan. Are you then kind of telling the marketing team of like, these are the metrics you need to be hitting to
Yeah, exactly. Like, so like a lot of the brands we'll sit down with, especially the ones who are on our growth service as well, because we're very aligned. So we've got a model forecasting. We'll sit down and say, right, if let's take a subscription-based brand, right, because that's quite easier to see. There's a lot of key metrics we look at. Number one is what's the take rate on subscription. So what percentage of people are coming in on first-time order taking a subscription? Because like it's another law, I would say, we call it, like, but the LTV on a subscription is, much more valuable than an OTP. You're probably talking 2, 3, 4x over a 12-month time frame. So if you increase that take rate, you can increase your CAC. So we say, okay, if take rate's at X, our CAC ceiling is Y. So we can spend as much as we want, we get the cash in a minute, as long as our take rate stays here, okay? And then you look at the order retention. Okay, of the subs that come in, then how many repeat order in month 1, month 2, month 3, month 4? Now that's quite nuanced because some brands might run, buy a 3-month supply up front. So their order retention won't be till month 3. So you have to factor that in, but you're getting more cash in the door day 1. And then you can get really detailed and really plan out things that make a lot of sense. And when you plug all this stuff in, right, the most important thing of any CFO is cash, right? Because without cash, you're dead. When you plug all this in, then you will see your cash flow. And you will understand, okay, we've got a gap here, guys. We need to go and either, borrow money, raise equity, work on our cash conversion cycle, work on our suppliers, get credit terms, get credit cards, or we have to pull back road a bit because if we push too hard, we're going to get in trouble. Play the long game, right? The goal in business is just to stay alive, because if you stay alive, you learn, you grow, you develop. It's not to win, it's to stay alive.
Yeah, interesting. Okay. So everything comes from those kind of first principles built out in the operating model.
Yeah, keep it people overcomplicate it, keep it very, very simple. Know your margins, know what your CAC can be, and if things aren't working, don't be reactive, be proactive. A lot of times I'll see brands will just try to push through the pain. And what I mean is, things aren't working, overspending, losing money, etc., etc. A lot of times you're better off just pulling back a little bit, taking a breather, figuring things out and going again. I think there's this tendency in the D2C space where people think they're on borrowed time or something, that if I don't grow as quick as possible, I'm in trouble, but it's not the case. It really isn't the case. So yeah.
Where do you think the kind of finance function sits in the business? And I guess what I'm asking here is that decision-making layer at the top.
Yeah.
How are you kind of getting involved with that?
Yeah, so the way I like to structure a lot of businesses is you'll have, let's say the C-suite. So you'll have a CEO, a CMO, a COO, CFO. Some brands have a CTO as well. Yeah. I think the secret to not the secret, but one thing that helps a business be very successful is each C-suite person has a very strong number 2. Okay, head of marketing, head of operations. CEOs will have the C-suite below them, but they'll also have a very strong executive assistant, head of finance, right? Those heads should be the ones running the day-to-day. They should be the ones running the operations day-to-day, right? What that means then is the C-suite they're setting the vision and the strategy. And they own the function. So I own the finance function, for example. I know what to do, when to do it. I can see around corners, whatever, but I shouldn't be doing the work. That's the head of's job.
Operationally, you're not.
That's the head of's job, right? And that should be same across the board. What that means is then the C-suite have got mental bandwidth and time to really think strategically. Because if they're in the weeds, firefighting every day, they're not looking at the bigger picture. They're not looking ahead. So to me, that's the best structures. Now, easier said than done, right? Especially in the early days. You're not going to have the capital, or you're not going to have the budget to have all these layers. But just having free time to think strategically is such an ROI.
Is that kind of only possible for brands that are at the 8-figure level to have the kind of capability to build out that structure?
No, I think a lot of brands overcomplicate things at the 7-figure level. If they kept things a lot simpler, so maybe keeping their SKU count down, not getting distracted by different channels or different markets. You can run up to 7 figures in one market on one ad platform. So let's say you could do UK, Meta, one SKU. You could get to multiple 7 figures easily. I think a lot of brands, they diversify too early, and there's no need to. And when you diversify, it's more work, right? It's more things to do and more things to manage. So if you keep it simple, it'll keep that space free.
Let's say there's a brand that has kind of overcomplicated things. How would you advise them to go about that cleanup process and strip things back?
Yeah, look, I think we do an audit of the business and look at the numbers and say, right, where are we getting the biggest ROI right now? What SKUs, what market, what advertising channels, what people. Just do a full audit and be very, very honest, and then just make the hard decisions.
Okay.
Cut, get back to basics, get making money, and then go again.
And do you think people kind of overcomplicate things through fear? So fear of over-reliance on Meta, or... I think
fear is probably one. I think fear is definitely one reason. Another reason might be money Twitter, or looking at what everybody else is doing. Yeah. And then thirdly...
Shiny object, right?
Yeah, exactly. Maybe that scarcity mindset, maybe if I don't launch on TikTok Shop or whatever, I'm gonna miss the boat on something. Yeah. And then I'd say the most important thing though is just not having the right people around them that have been through that journey before, that can kind of advise them and say, look, you know, we've been here before with different brands. You know, we saw that when they did this, it actually made things a lot more complicated. Overall performance went down because you're stretched. You're not focused on the thing that's working. So, like, unless you're hitting a ceiling, like, my advice would be just keep doing what you're doing, keep it simple, and then diversify.
Okay. I know when we spoke before, we kind of had a chat about, like, how does the finance function, the marketing function interact? I think there's kind of like a fear on the marketing side of the finance function of, like, oh, they're just here as like a, you know, ball and chain essentially, right? And like they're trying to drag us back. What do you think about that?
Like, I think in any business, right, growth and marketing is the most important part, right? Like, without growth, without marketing, without revenue, every other department is redundant. So I think there has to be respect between both departments, first of all. Like, finance need to respect and understand that, like, marketing is the heartbeat, marketing is the engine of the business, okay? And, like, you need to give them the tools they need to grow, okay? The best finance people understand marketing at a high level, so they understand how it works. Like, I couldn't run an ad, you know, I can't do a creative like it. That would bankrupt the business. But I understand the unit economics. I understand, like, if you put X into the machine, Y comes out. I understand, you know, sometimes you have to invest in brand. Sometimes we need to lose money to, you know, test ads, test creatives, right? I understand that. And then marketing people also need to understand, like, you know, finance people, okay, they've got a cash flow to manage, you know, they've got numbers to hit. Like, they're not doing this to hold us back, they're doing it for the benefit of the business. So once you have that mutual respect and you sit down together and you work together and have synergy between ops, marketing, and then the founders, that's the key to eCom, is when everyone's aligned and in sync and has a plan and sticks to it and supports each other, that's when great things happen. Okay.
And in that kind of council, is it a democracy? Is there one party kind of in charge and having final sign-off, or how do you see that?
No, no one I work with anyway. As I said, like, when you've got mutual respect, like, everyone sits down, we discuss things, you know, we question things of each other, but we'll make a decision and we'll move on. And if that's not a decision that I agree with or someone else in the team doesn't agree with, it doesn't matter. The decision's made, you move on and you get behind it.
Okay, so it's like a collaborative kind of approach.
Definitely, yeah. Okay. Definitely. But because if that would be a massive red flag to me in a team, a leadership team, where if it was like a democracy, like, to me that would, like,
nothing gets done sometimes.
Like, where's the respect there, you know? Okay. I wouldn't sit on a leadership team where it was a democracy. Yeah. You're there for a reason, right? Yeah. But yeah, like, but even talking about leadership teams, like, you need to earn the right to be at the table too. I think one of my pet hates in finance is a lot of finance people are no people. Like, you know, they'll get asked something and their default response is no. Whereas if I'm asked something by, you know, a CMO or a founder or whatever, and I know we can't do it, like, I won't say no, but what I'll say is, look, I'll have a think, but, like, we can't do this the way things are right now, but let's put our heads together and see how we can make this happen. Yeah. So let's say they need more budget, but I know we don't have the cash flow. We can say, okay, we can get some funding, or we can like allocate capital from this project over to this project. So you're not saying no, you're saying, well, right now it's not possible, but let's put our heads together and make it happen. That's a way better approach as a team, because the other person, it's showing them respect. It's saying, like, okay, he said, like, you can't do it right now, but he's willing to work with me to make it happen. Like, who can argue with that that framework, right?
For sure. The next kind of bit I want to get into here, I want to kind of split into two. So I want to ask you a couple of questions and kind of pick your brain on tips for the finance side. But I want to start with kind of the smaller brands. So I know you have multiple companies that work across the board, 6, 7, 8, 9 as well, figure businesses. So kind of section 1, talk about, I guess, startups and kind of up to the 7-figure level, and then go beyond that. So what I want to kind of start by asking, on these kind of smaller brands, what should they be kind of focused on? Up to the mid 7-figure level, maybe, like from a finance perspective, what's key?
From a finance perspective, at that level, like, you're probably going to be doing a lot of the work yourself. So I think if you're at that level, try and get to know people at the 7, 8, 9-figure level, okay? And, like, do your research, like, understand every aspect of your business, like, get obsessed with learning about ops, like, how do the big boys run ops, okay? What's their supply chains like? Did they start like, you know, drop shipping from China to get proof of concept? Did they go straight to local fulfillment? Did they start advertising on 10 channels? Like, how did they start out? Okay. Same with finance, like understand the basic P&L, understand the cash flow, do it yourself at the start. It's the best thing you'll ever do. Because if you understand it, like when you grow and you bring someone in, let's say like myself or somebody else, you know what they should be doing. You have some kind of idea of what it should be. They're just taking time off your plate and bringing it to the next level. I think where a lot of founders go wrong is they pass off everything too early.
Okay.
Like if I was to start a brand today, like I would want to do everything myself at the start. It would probably mean slower growth, but at least I'd understand. So I'd want to do the finance, I'd want to do the ops, I'd want to do the paid ads, I want to do everything. It's just to know how to do everything within my business. That's probably one of the good things with our business, like the CFO, like started that from zero. So I've done everything. I've done absolutely everything in the business. I don't do it now, but I can. So I understand what people should be doing. So yeah, to cut a long story short, I would say network with people further ahead than you. Get courses. Like courses get a bad rap. I don't know why. Like a lot of the big brands we work with started with like Alex Fedotov and other guys in the space, right? Like it's brilliant. So yeah, do courses, learn everything, be a sponge for knowledge, you know. Yeah, that's how I would do it. Okay. 6-figure.
And then how do you kind of start to get out of some of that stuff? So like you said, you know, ads, finance, ops, let's say you're doing kind of everything. At what stage you like, I'm ready to kind of pass this off? The
great thing now about eCom, right, is like it's digital, right? Like you're on your laptop, so you can start getting like talent for quite cost effective in, let's say, Philippines, South America, Pakistan. Like there's some big brands we work with where like their marketing teams in Pakistan, and they're brilliant. So wherever you think is taking up most of your time and holding you back, try plug that in. Probably going to be ops, to be honest. Bring in like an ops associate to look after your stock, everything. That's fine. Then you might bring in someone to help you with paid ads or email, whatever. Finance is usually probably one of the last things someone might bring in at times, like in terms of like regular support. But just make sure you've got like a good accountant that understands eCom by your side.
And as the kind of founder or founders, like what would you say to them of like what they should keep on their plate and like continue to focus on?
I think every founder should stay close to growth. Like not run the growth department, but like be super, super close to it. Yeah. Like the most successful brands that we've ever worked with, like the founders have either run the growth division for a long time and or they're still running, like overseeing it or very close to it. Because indeed to see like that's the engine, that's the heartbeat.
Yeah. Okay. And from a finance perspective, at kind of up to that mid-7-figure level, what are the key things to be kind of focused on?
So by that stage, like you should have proven product market fit, right? So if you're at that mid-7-figure level, right, you need to really look at like your P&L, your unit economics. Like, do they make sense, right? Or are you just scraping by every month? Because if you're just scraping by every month, it might be a signal that okay, you're obviously a good operator to get to mid-7 figures. Like that's no mean feat, but maybe you've got the wrong structure. Maybe you've got the wrong product. You know, maybe the wrong market. So really look at it and go, right, do I see this business going to 20, 30, 50, 100 million plus? And then you can start bringing in people around you to help you get to those levels.
Okay. If you think you need to change some of those variables, how would you go about doing that?
It definitely need to be a transition, right? Because you can't just cut everything. So let's say, for example, your unit economics aren't stacking up or something. You could change your offer. Maybe your CAC is too high. You could change your offer. You could change your market. You know, you could change your supply chain. A lot of brands that we see that scale really quickly, they will start with, they'll start by drop shipping in from China. They're a brand, but they'll have all their manufacturing and their fulfillment done from China. Yeah. What that allows you to move super quick. So you can launch a product in a couple of weeks if you've got a good sourcer. It really helps with your cash conversion because you just need to put down a small deposit for the stock and then you're just paying, as you make sales, you're paying then your partner in China for the stock and the fulfillment. So you're not having to front load all the stock. That allows you to prove product market fit very quickly and it really helps with your cash conversion.
So that kind of cash conversion, the CAC or the unit economics are the main things to kind of focus on. Yeah,
like product market fit, unit economics, and your cash flow.
Okay. Anything else that you'd be kind of looking at, or are they the main ones?
In what sense?
Just as like key KPIs to be kind of looking at as the founder.
Yeah, so again, obviously you just split it if you're a subscription business or like a one-time purchase-based business, and then is your CAC stable is another one, I think. Like if your CAC is quite volatile, that's quite worrying. But like if you're a business where your CAC is pretty stable and it grows in a pretty stable way as you grow spend, like from an incrementality point of view, you're in a really good place there. I think a lot of people too in eCom look at it quite in reverse. They will all say, I want, the highest ROAS possible. They'll want the lowest CAC possible, etc. You want to flip that. You want to like optimize your business. You want to have like, your margin so dialed in.
Yeah.
You want to have your LTV dialed in that I want to be able to spend more than my competitors to acquire a customer than them, because I know my margins are better, my LTV is better. So it means I can just own that digital shelf. I can outcompete them because the unit economics still makes sense. So
you're kind of like thinking, how can I like be on the offensive from a marketing perspective rather than like a defensive?
Yeah, that's a good way to put it. Exactly. Like, like if you add like, $2 to your gross margin through better product pricing, through higher AOV, whatever it is, that means now you can spend $2 more to acquire that customer, and wouldn't even end up in the same position. You probably end up in a better position. You end up in the same position order one, but LTV will start to flow in then.
Okay. I know when you spoke at the start, you said they kind of did make a decision on the North Star kind of goal of the business. Is it to, maximize revenue growth or, cash in the pocket of the founder? How would you help a founder make that decision? Or what should they be kind of thinking about there?
Well, I think like that's definitely only a decision they can make. I can just share my experiences. Like I think a lot of the time, like exits are maybe sometimes over glorified, put on a pedestal, and running a business that is growing and gives you good cash and gives you a lot of fulfillment is underrated. Because if you attach, let's say you want to sell your business and you attach all your like success and happiness or whatever you want to call it to the end outcome, there's going to be this gap in time, right, where you're not really present or you're not like enjoying it. Whereas if you say to yourself, right, I'm gonna build a business that I could sell, right, but I'm going to be happy either way. So I'm going to build a business where I work with great people, it makes me good cash, I enjoy it, and it fulfills me, and it supports my lifestyle. But I'm building it in a way that I could sell it, so I've got the right, let's say, financials, got the right people structure. Doing everything, you've got the right compliance, whatever. Then whatever happens, you're going to be happy, right? If you sell it, great. If you don't, you weren't waiting for that moment. So that's kind of how I phrase it to the people we work with. So you want to keep optionality.
Are there kind of stages in that journey though of like, maybe at the start it's like you kind of have to maximize the revenue growth and you can't take much cash out of the business, and then you get to a point where you're like, okay, now we're going to kind of switch? Yeah,
like I would say for 90% of brands, those early days, like, the founders are not taking much cash out. Your margins are tight, right? Especially in the early days when 6, 7, even up to low 8 figures sometimes. You're reinvesting everything, right? Like money's gone back into stock. You want to keep healthy cash flow. Like it's definitely a balancing act. So they're the difficult years for sure. But once you blow past that, you start making good. If you've done everything right along the way, like you will start making really good money. But there's different journeys, right? So I would say you've got the 0 to, let's say, 500k a year mark. You've probably got like the 500k a year, maybe to 2 mil, 2 to 5. Then I would say maybe 5 to 20, right? And then 20 to 50. 20 to 50 we call the value of debt, because when you get to that size, you can't really do it all yourself. Like that's when you have to. People are aware of you, so you're gonna have copycats. Your CAC's gonna be much higher at that size. You have to build teams, build org charts. More shit's gonna happen. You're more like I kind of compare it to like when you're smaller, you're like a little dinghy. You can pick it up, you can throw it around, you can pivot really quickly. But when you're that size, you're more like a steam tank. Like if you veer off course, like you can't just correct it straight away. It takes time. So for example, let's say like if your CAC is off and your profit's behind forecast, whatever, your cash flow is behind, like you've got a team to pay. Like it's much different. So when you're at that like 20 to 50 million mark, like you have to really be dialed in, and you have to be like just looking around corners at all times and having plan Bs, plan Cs, plan Ds. we'll always have or try to have access to capital that we don't need. It's there for emergencies, stuff like that.
I want to just go back to those kind of stages that you talked about, because I think that's interesting. For a founder that's trying to maximize like personal happiness, maybe they don't want like a huge team. They don't want to kind of necessarily rip the scale and kind of that side. Is there a size of the business or stage, as you said, where you think that's kind of optimal as a lifestyle kind of brand?
Yeah, there's a few people I know that are probably doing around anywhere from, I would say, $500,000 a month to $2 million a month that are at that stage where they're still super, super lean. They're making really good cash. And they don't treat it as a lifestyle. They want to keep growing, but it could be a lifestyle if they wanted it to be.
So like headaches per dollar earned in that slot, you think is kind of the sweet spot?
Yeah, exactly. Okay. Yeah, especially if your business is structured like really lean, like as I said, like maybe sourcing in China, you might be drop shipping in or holding stuff locally in fulfillment centers, low SKU, not running many channels. But I think as any founder, and you're the same, I'm sure, enough's never going to be enough. If there's opportunity to grow, you're gonna jump on that. You're not just gonna go, right, I'm at $1 million a month now, and just gonna stop and take the foot off. You might do it for a couple of weeks, but you'll get bored.
Okay. And then in terms of those different stages, are there certain kind of financial profiles that you'd allocate to each one? And I'm thinking here, like at the start, is there like a certain margin profile that you'd expect it?
It's definitely varies business to business. And that's, you'll see people spout generic stuff online, saying you have to have your gross margin at 65%. One of the most successful businesses we work with, their gross margin is much lower, but the reason they're so successful is their MER or their ROAS is super high because they run offers. They what they sell is one of the best deals out there. So they make it back on that. So back to the point earlier, you need to look at your business strategy and your unit economics and your contribution, and does that balance make sense? So if you try to push your gross margin up, a lot of the times you're pushing your AOV up, which means then you might have to pay more to acquire a customer. So there's no right or wrong way. It just needs to work for your business and your bottom line.
Okay. I want to kind of switch to the second part of this finance side now and talk about the bigger brands, so kind of 8 figures and beyond. How does what you said to focus on from the finance side in terms of unit economics, all these kind of different KPIs, how does that change as the brand gets bigger?
I don't think that ever changes. You need to always know that. You need to have some sort of system for reporting, your profitability. Whether it's on a daily basis, weekly meeting, someone needs to own that. Especially, let's say, if you're running multiple channels or different funnels or different markets. That's never going to change, no matter what size of a business you're at. Then it just becomes more, there's more to manage, right? So then it becomes more about building teams and giving them the tools they need to do the work that needs to be done. Okay.
But are there kind of additional KPIs or different kind of focuses that you would put for 8 or 9 figure brands versus the smaller guys?
I would say when you're at that size, the small percentages make a bigger difference. So when, let's say, you're 8 and 9 figure brand, you're really going to want to be optimizing your margins. So you want to be constantly talking to your suppliers. We call them nibbles. So anytime you're speaking to your supplier, ask them for something small. Ask them for maybe, okay, last time I put 20% deposit down. Can I do 18 this time? They'd be like, yeah. And if you do that over time, your cash conversion is going to get much better. You might ask them for a couple of cents off on a SKU. But if you, instead of just doing it once or twice a year and asking for big discounts, just doing small over time, optimizing your margins, you'll have way more leverage too. So you can speak to your payment processors, right? They don't want to lose those volumes. You can attract better talent because you're a bigger business. You're well more established. You're probably, but again, it's the same principles. You're going to be really dialed in terms of cash flow because at that size, you need to be on top of that, on top of your compliance, your tax compliance. I actually don't think there's much difference, to be honest, what you look at for a brand doing 100K a month to a brand doing 20 million a month. It's the same principles, it's just at different scale.
Okay. And are you doing more kind of detailed forecasting for the guys that are above the kind of 7 figure level?
Yeah, 100% you are, because when you're at 7 figures, you don't have, number one, as much history or data, and number two, it can be more volatile. So your forecasting is probably a little bit more basic, but But yeah, for the big players, like, you're definitely doing some really detailed forecasting. You're refreshing it every month for, like, we do cohort-based models. So, like, you're not going to acquire the exact amount of customers you put in the forecast in the next month. You need to update that, because that's going to drive your return on customer revenue, the amount of customers you acquired in a month, what bucket do they go into, and then what's your order retention, and your AOV could change. There's things that are constantly changing. So updating that, and that's one reason as well why we built our SaaS product. That does all that now live. Like, it's plugged into everything, so it's just constantly refreshing. Refresh the forecast. It's pulling in information from Shopify, Checkout Champ, ad platforms. So it just saves all the manual work of the team.
Okay. And in terms of kind of growth, do you have recommendations for business of, like, expansion and, talking here about, like, markets, platforms, or channels, sorry, and SKUs, like, any thoughts in general on kind of preference?
Obviously, the US, right, is where everybody wants to be. Like, the scale in the US is unheard of in the D2C space. But, like, you can be successful also not being in the US. Like, we have a lot of brands that are really, really successful that either don't sell into the US, or it's a very, very small percentage of their revenue. Like, there's opportunities everywhere, to be honest. Like, if you're an operator, there's opportunities everywhere.
Yeah.
So it's really about looking at your options, getting some information, not rushing a decision, and then going with it, but not being afraid to cut that if it's the wrong call. So we've had loads of instances where we might enter into a new market. The numbers aren't what we thought they would be, but we kill it quickly and allocate that capital somewhere else. Might have launched an ad platforms, killed it. Might have launched a new, let's say, what's the words? Like a new product line, for example. A new category didn't work, cut it.
Okay.
So you need to be, I would say, slow in making a decision. I don't mean slow in taking months like corporate, but, like, not saying today, right, we want to launch into Germany, and then tomorrow launch in and say, okay, today I want to launch into Germany. Let's take a week or two. Let's pull some information. Let's speak to people we know in the space. Then let's make a decision. So 2 weeks, then you launch, and then you don't launch, and then once you've launched, keep a close eye on things. And if we're not seeing directional data that's positive, cut it quickly and move on to the next thing.
Okay, so it's like a thorough decision-making process, and then small tests, and act on the data.
Yeah, exactly.
Okay. You mentioned there kind of the expansion to the US. How do you help brands kind of think through that kind of cross-border stuff?
Yeah, it's a good question. So whenever you're going into a new market, especially a big market, you almost need to treat that as like a new business division or a new business unit. Like, my view is, right, if you're still in the 7-figure space and you're growing and you're doing well, I would stick to your home market. It's where you grew up, right? You know the social norms. You know people that can help you. Stick to that. Unless you hit a ceiling or whatever. But you shouldn't hit a ceiling in your local market, in the 7-figure space, unless you're in a very, very small market. Ireland's probably one example, but a lot of brands I know in Ireland have got to 8 figures plus, just in Ireland. So let's say then you're in your 8 figures realm and you want to hit the US, right? You need to accept that you're going to lose money at the start, right? So you need to allocate capital and set, like, we call it like a maximum burn rate. So you can say, right, the maximum money we're going to burn when we launch into this market is 50K a month, 100K a month, 200K a month. You set that budget aside, and that's your war chest to go into the market. If you can't make that work with that war chest, you have to cut it. Or if it's working, right, but it needs a bit more cash, but everything stacks up, we're getting traction, CAC is in a good place, whatever, margins are good, you need to allocate more capital to it. But you need to accept that you will lose money to start, you will make mistakes. You want to do your research of competitors in there as well. There's so much information out there. Speak to people in the space. Then we will look at the supply chain. Okay, if you're a European brand and you want to launch into America, and we're sourcing from China, as I said earlier, do you just drop ship in to begin with? So you can move quicker, test the product market fit. Do we actually set up a 3PL or get a warehouse in the US? Definitely wouldn't recommend setting up a warehouse day one yourself, but you might use a 3PL if you like bulky products, for example. Finding the right 3PL partner. We have lots of partnerships across the world. 3PLs, lenders, marketers, whatever in the space, payment processing, can be anything.
Yep.
We have access to that network. Decide on that, so treat it like a new business or a separate business division, and then build it from the bottom up, then and make a plan.
Okay. Are you kind of allocating team or building a new team? Let's stick with this, like UK or Ireland to kind of US expansion. Are you building like a US team from day one, or is it, let's prove concept and then start to
prove concept? Yeah, definitely
Okay.
prove concept. That's one thing you might do, again, depending on your size, but let's say you're, doing 20, 30 million a year,
Yep.
and you want to really go heavy in the US, you might, hire a performance marketing agency or retention agency that specializes in the US, for example, to work with you. You might, as I said, alter your supply chain a little bit, but you might, and then you might task someone within the business to be like, call it country manager, to own that market to get it off the ground. But I wouldn't go out and like build a new team for that specific market. Number one, it's going to be slow, and number two, if you need to cut it, like, it's going to be a lot of headaches.
Okay.
And number three, it's your business, right? Or the people in it, that business. It's a much higher chance of success if they lead it and they run it.
Okay. As we kind of start to round things off, I want to talk about funding and kind of financing in the space. How should brands think through, like, whether, one, they kind of need financing or kind of want it, and then two, how to evaluate their options?
Yes, I think the first thing, again, it all comes back to this unit economic piece, right? If it comes down to why are you borrowing money? If you're borrowing money to cover losses, that's a really, really risky thing to do, because that needs to be paid back at some stage. And if you're like betting on the fact you're going to be profitable one day or things are going to get better, like, that's a pretty risky thing to do. You're better off like not taking funding, pulling back, fixing your business, fixing your structure, making things right before you borrow money.
Yep.
But if you're growing right really quickly, and you mightn't be profitable order one, but your economics are very, very strong, and you're borrowing to fund profitable growth, and it's done in a way where someone like myself or an experienced finance person can sit down, go through it, do different scenarios, model it out, and you're very confident you can service that debt, and it's to fund profitable growth, then it's very, very good. You also need to understand, what are you borrowing the money for? So if you're borrowing money for, let's say, like working capital, marketing, stock, etc., short-term lending is fine. But if you're borrowing money to, acquire a business, build a factory, like a warehouse, buy some IP, then you can't use short-term funding, because you're not going to get the cash flow from that asset, right? So you need to look at like different types of funding. So if you're getting a property, for example, like a warehouse, you speak to a bank, or a property lender. If you want to, acquire a business, again, you need to look at that. So that's on the debt side. And then the other side is you can raise equity.
Yep.
So again, if your goal is to grow this business and you're 100% sure that, you want to sell it, then raising equity can be a very, very good route, because they will help you get that sale, right? Or, let's say, again, you've got a business, you've got a vision, you believe in it, but you're loss making, but you're very confident it will come good. Again, raising equity is a very good choice there, because it gives you that time and that runway.
Okay. You've talked there a lot about kind of the options and how to make the decision. Once you've made the decision of like what you want the financing for, if it's the right thing, and you start to go down that path, what does a kind of typical process or kind of timeline look like for this?
It depends. Like, there's one guy reached out to me recently. He needed cash quickly, and I was able to get him like $500,000 within 24 hours.
Wow.
So it really depends on speed, but the quicker you get it, usually the more expensive it is. So there's loads of great lenders in the space, right? You've got like Wayflyers and Caps of this world, right, where you can get funding pretty quickly. But again, this comes down to, but do you have the numbers as well to back it up? So, like, they will look at, to get like up to $500,000, you can get it pretty quickly, pretty easily. But they will plug in your marketing data, and they will use analytics to see, like, is this a viable business? Get cash pretty quick. If you want anything more than that, like, you're going to need like, profit and loss, balance sheet, forecast. That's why it's the importance of having a good finance function too, is you'll have all that ready to go. If you want to get more, let's say, longer term debt, more cost affordable debt going to the banks, like, that can take months to get in place. Very difficult for D2C brands, because they have no collateral, right? They have no assets on their balance sheet really that they can use to secure that lending. So a lot of it is like the growth capital of the world, the Wayflyers, Young Caps, etc. And how do you do it? is like reach out to a broker or reach out to somebody like ourselves that has done it before, knows the process. They'll get you multiple options. They'll know what rates they can get you. They'll get you the best terms. You know, they'll review the securities if they're securities, and they'll also look at the affordability. Like no self-respecting finance person is going to allow you take debt that they know you cannot pay back, right?
Okay. Final question is on exits. So assuming that is kind of what the founder is building for, how should they go about kind of prepping for that exit, and what are kind of the green flags, I guess, from the acquirer's point of view?
Yeah, it's a very good question. So I think if you want to sell your D2C business, like you need to realize that you're not going to be sitting across the table from someone like me or you. You're going to be sitting across the table from someone probably, you know, in their 40s, 50s, 60s, corporate background, not D2C. Super, super high level, super intelligent, right? But they're not D2C people, right? So, and again, it depends whether you want to sell to private equity, a strategic buyer, family office, whatever. It's different. I suppose they look at things differently, right? But you need to, if you want to sell your business, like you need to start getting ready 2 years out. Like it's not 6 months, it's 2 years. You need to have like proof that you've set targets and forecasts and delivered on them. You need to build a very strong management team. If you're very serious, I would suggest appointing like a non-exec director, like someone that's has, you know, built and sold a business, been a CEO of a big business, join your board. They will add a lot of weight and help you through that process. Having a very, very good finance person is key. So when you go to sell your business, obviously there's due diligence. So they'll go through everything with a fine-tooth comb. They will do financial due diligence. They will do like operations due diligence. They look at your supply chain. They look at your IP. They look at your taxation. They look at your legal. They'll go out through everything. And that's what kills a lot of deals, you know, not being ready. Have a data room ready. You want to start speaking to brokers about, you know, 2 years out. They will look at your business. They'll help guide you where you need to be. They might start getting you on the radar of potential buyers, especially if you want to do a strategic sale to like, I don't know, Procter & Gamble or a Nestle of these worlds. So yeah, like the main thing would be get someone on your team or by your side that knows what they're doing and has been through it before. That could be someone like me. It could be, you know, a sell-side M&A broker. It could be an investment banker. It could be an advisor. It could be a non-exec. But just get someone in beside you that doesn't have to be full-time, but just get someone around you as an advisor that's been through it, knows what to do and can help you get ready.
Nice. Okay. Seamus, thank you so much for coming on today. I've learned a ton, and I'm sure everyone else has too. Where can people kind of get in touch with you, find out more and look at working with you?
Yeah. So you can just look at our website at www.e-clarity.co.uk. Find me on LinkedIn, Seamus O'Connor. You can find eClarity on Instagram. I'm sure all the links will be below, but
for sure.
Yeah, you can find us there. Feel free to reach out.
Perfect. Thank you.